Hi, everybody, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and the senior portfolio manager at McNichol & Associates Asset Management. This past Tuesday, we had our quarterly recession indicator webinar, where our resident technician and market cycle expert Gilbert Inanager provided an extensive review of the U.S. and Canadian economy. We started this series in 2022, when many feared that the economy might be heading for recession. But we have now been 7 for 7 in reporting that the data as we see it still says up, up, and away. We intersperse these recession indicator webinars among our regular weekly update webinars to provide our clients with greater insights into the SVA methodology, updates about some of the 2,800 valuation stocks that we track, the economy, and sometimes even politics. For those who are interested, we have almost 200 webinars recorded and available for your viewing pleasure. So, if you've been with us on FANG Friday for some time, I would personally encourage you to take advantage of our 3-month trial to join our investment family. Just email me at info@strategicanalysis.ca and we'll get the ball rolling. Among other reasons for that 3-month trial is that I will want to see if your investment style aligns with our service. So, no pressure. But sometimes you never know what you're missing out on. This past week was pretty much steady as she goes. The price trends of the FANGs remain steadily intact, although I can cheerfully observe that Alphabet has now, mercifully, pulled back from its putative potential sell signal. So without further ado, let's take a close look at those FANGs and what went on in this past week. But first, as always, I do like to say thanks to everyone who likes this video and all our subscribers. It really helps to grow our channel, and we appreciate it greatly. Okay, well, let's start off with Amazon. Nothing much to report here. The stock just continues in that nice sideways trend. By the way, that nice sideways trend mirrors the balance sheet, which is growing at about a 20% compound rate. So just standing still actually yields a positive return. The same goes for Netflix as well, and that's been sliding sideways. But, okay, its balance sheet recently has been growing at about a 24% rate. So again, just going sideways yields a positive return. Microsoft just continues to sort of knock at that HB2, but so far has been unable to get through. However, again, okay, just tracking the HB2 yields you a compound rate of return of 21%. Alphabet, after to its mid-super growth price, that's 5.5 times book, and breaking very slightly through it, has pulled back on side. And as you can see, it's done that before. Can be a little unnerving, but nonetheless, if we can track along the mid-super growth price, okay, it yields a reasonable rate of return of something in the order of 20%. Meta has been trying to break out over its bubble price. And what I find really intriguing about that is that every time that the stock has gapped up, that it has moved on strongly to the next breakpoint. So we go back here to January of 2023. Gap moved pretty quickly on to its LSG price. That's 4.5 times book. Gapped again, moved pretty steadily and quickly on to its mid-super growth price. That's 5.5 times book. Well, it gapped again here, but it has been a little lethargic in moving any higher. And why do you suppose that is? Well, two things. Okay, and the first and most critical is that the stock has come right up against its bubble price, and that has been a 10-year high on the stock. And in our experience, it's difficult for companies to actually break out to new highs. Nvidia has it's just moving either side of its HB7. That's 42 times book value, and the question is, can it move higher from here? One of the things that I note, by the way, is look at the trend of the fair market value. That, of course, is the trend of earnings forecast. And it very, very recently has slowed down, and the stock has slowed down trying to break out over its HB7 price. Now, I want to show you something quite interesting, because I ran into a comment by one Jeremy Siegel, who I'm sure you've all heard of before, the man who's rampantly bullish on the Dow. And he is saying, look, if this company can match the highs of Cisco back in 2000, then this company can triple. Well, I thought I'd better take a good hard look and see what he's talking about. So, first of all, I looked at the long-term trend of Nvidia, and you can see that well, it's at an all-time high, up at its HB7, 42 times book value. And then I said to myself, well, okay, let's go back to 2000 and see what Cisco looked like. So I did, and here is Cisco back in 2000. Well, I hate to break it to Mr. Siegel, but Cisco never managed to get much above its HB5, which is some 35 times book value. So one wants to be very careful here. Another thing, by the way, that's very interesting is look at what happened at the end for Cisco, the growth rate. Okay, they moving along, and then this had this fast swoop going into 2000, and then it flattened out. The stock didn't have to lose money or fail to produce good results, because it carried on doing that, well, for a little bit anyway, before slowing down. But by that time, the stock was already well on its way down. So we have to be very, very careful to make sure, as far as Nvidia is concerned, that it is not losing any of its sales and earnings momentum. Finally, well, not finally Apple, but finally the two stocks that I do not care for very much, and the first one is Apple. And you can see here that Apple has been it's fallen too, and then moving along its HB5 price. Okay, that's 33 times book value. Now, today I notice that the stock has slipped through that breakpoint. So I'm going to be watching very carefully to make sure that this is for real. If it is for real, we might expect a further breakpoint down. And of course, why is that? Well, we've got very, very little growth. In fact, almost none at all in sales and earnings. And finally, last but hardly least, Tesla has been streaming down rapidly towards its bubble price here, that 7.4 times book value. And it's going to be very interesting to see what happens when it gets there. Of course, its intrinsic value has been falling, although it's ticked up just a little bit recently. But the last time the stock got to the bubble price, it had a nice bounce. So I shall be watching very carefully here. The stock has actually met my initial downside target, although quite frankly from a longer term point of view the stock is still has some 61% to go before it falls to its fair market value. Anyway, right now we've got to watch this one very carefully. So, to briefly recap, Amazon and Netflix are in a clear bullish modality, although their prices aren't exactly running away. Microsoft is still unable to break out over its HP2 price, that's 12 times book, although I hope that you noticed that if it carries on close to that valuation, the balance sheet growth rate gives you more than a 20% annualized gain. Alphabet pulled back across its MSG price, that's 5.5 times book. So all is well after a mild shock across our bow. As we had seen that 2 times before, this did not come as a surprise. Now, the 2 hot story stocks, Meta and Nvidia. Meta may have broken out over its very long-term valuation high, its bubble price, or 7.4 times book, but it's now struggling to gain some price momentum, as you can plainly see from the graph. The market has a memory, and I suspect that we may need another great quarter before the stock can shake off its own past. For your information, that isn't due until the beginning of May. So we may be watching the stock nervously for a bit before we get a trend resolution. Nvidia is struggling at its HB7 price, that's 42 times book, a very rarefied valuation indeed, especially given that its fair market value measure is now some 62% below its current price. It's interesting to consider that the stock needs earnings momentum, and you can see that the analysts have been easing back in their forecasts very recently. As I showed you with the Cisco example from the last high-tech boom, you don't need an earnings setback to really crush a high-flying stock. Just a modest easing back on the sales and earnings momentum. Hey, the bulls are having none of it. A slowdown, I mean, and are forecasting higher and perhaps much higher prices. Color me optimistically nervous. As for the 2 weak fangs, Apple has now fallen to support at its HB5 price, or 26 times book, and so far is holding. It has been oozing lower since August of last year. And as Rodney Dangerfield might say, just can't get no respect. With no visible growth, I have to agree with the market. However, good structural support can be solid support, and we can't ignore it just because of personal feelings. Keep a close eye here. I must say that in my own opinion, if it does choose to rebound here, I doubt that it will be a runaway situation. Finally, Tesla is almost down to its bubble price, 7.4 times book. Now, as you saw just now, it did rebound there very strongly before, and I would not rule out at least a pop when it gets there again. The alternative, a failure to hold here, is not pretty to contemplate. Although a failure here would be very much in line with its fundamentals as I see them. In total, summarize where I would see each of the fangs at present I'd want to be holding Amazon, Netflix, and buying or adding to Meta and Nvidia on their breakouts over their key breakpoints. I would hold Microsoft, but I can't rate it as a buy unless it can break out here over the HB2 or 12 times book. As far as Alphabet is concerned, I'm breathing more easily now that it's safely back across the line. Apple and Tesla remain in my bad books from a fundamental point of view, but may well offer rebound potential. Apple is on SVA support, and Tesla is getting close to a very powerful SVA breakpoint. So keep an eye out. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next Friday.